Most people assume that once you sell an investment, Uncle Sam is waiting with his hand out. Stocks go up, you sell, you owe tax. End of story, right? But here's the twist. What if I told you there's a completely legal way to sell your investments, pocket the gains, and pay zero tax? It sounds like a loophole, but it's actually written into the tax code, and if you're retired or close to it, you might be sitting in the perfect position to take advantage of it. Today, I'll show you how the 0% capital gains bracket works, how to use it to create tax-free income, and also a couple of big mistakes to avoid so that this strategy doesn't backfire on you. First up, go with me here. Think of your portfolio like an orchard. Every time you pick an apple off the tree, meaning you sell a share of stock, the IRS wants a bite. Now, there are two kinds of bites. Short-term gains. That means you held something less than a year before the tax liability was created. That's taxed like your regular income. And long-term gains. That means you held the investment for more than a year. Those are taxed at special rates. And that's where most people stop paying attention because honestly, sounds like this video is going to be really boring, but stick with me, it won't be. They think that it's always 15 or maybe 20% for long-term capital gains. The tax code actually has a third rate, 0%. Yeah, you heard that right. Under certain income levels, you can sell your appreciated stock and pay nothing. That's where things get really interesting for retirees. Now, it's important to note here that we're talking about after-tax money. This is money in a brokerage account, not in an IRA or a 401k. They have their own tax rules. Capital gains don't come into play there, which is another reason why this stuff is so confusing and people miss out on some of these great planning opportunities. And so now that we know the basics and we know that a 0% capital gains bracket exists, how do we get it? Here's the magic number for 2025. Married couples filing jointly can have up to $96,700 of taxable income and still fall into the 0% long-term capital gains bracket. Over that amount, up to just about $600,000. Then you fall into the 15% bracket, and above $600,000, $50, you go up to 20% capital gains tax. For single filers, that magic number is anything up to $48,350 of taxable income. That's your cap for the 0% bracket. Above that, you go to the higher levels. Now, notice this is very important. I said taxable income, not your total withdrawals, not your gross pre-tax income. It's what's left after deductions. And here's the good news. Those deductions recently got larger, especially if you're over the age 65 and you qualify for the new One Big Beautiful Bill tax deduction. Here's a quick breakdown of how that works. The current standard deduction for a married couple filing jointly is a little over $30,000, $31,500. If you're over the age of 65, you get an additional deduction that could take the two of you up to $34,700. And now, as a result of One Big Beautiful Bill, if you're over 65 and you have a modified adjusted gross below $150,000, a married couple gets an additional $12,000 in deduction, which brings your grand total to, drumroll please, $46,700. Now, what does this mean? This means you can actually have income well above that $96,700 that I mentioned and still be in the 0% bracket. Now, to be fair, it's never quite that simple, and there's some specifics that come into play here, but the key is to know this. These numbers are based on your taxable income, which is different from your actual income. In a second, I'll explain exactly how to put this to work, but I want to point out to you that if you thought this was a strategy that only worked for folks living on beanies and weenies, it's not. Plenty of retirees with incomes north of $120,000 a year can still use this to their advantage. This is exactly the kind of stuff we do for clients using the Clear Vision retirement plan. Check the link in the description to see how we can help you keep more of your money in your pocket and not on its way to Uncle Sam. Now we're going to put it to work. We're going to put this in action using a strategy called tax gain harvesting. You may have heard of tax loss harvesting. That's a different thing. Tax gain harvesting, what we're talking about, works like this. 1, you sell appreciated investments while you're in that 0% bracket. 2, you immediately buy them back. Yep, you can do that. You can buy them back immediately because there's no wash sale rule for gains. Wash sale rules are a thing when you create a tax loss. The IRS will happily let you pay tax gains anytime you like and buy the thing back. But here's the beauty. Remember, if the income's at the right level, you don't have to pay them at all. And bonus, 3, now your cost basis is reset at a higher level. Here's an example. Let's say that you called me up and you said, hey, Antonio, I bought this stock for $50,000 some years back. It's worth $100,000 today. Now, let's assume that you like the company. So we go through the whole thing. You like this stock. You don't want to sell it. And so you say, Antonio, I don't want to sell my stock. I believe in this company. That's fine. Believe all you want, but sell it anyway and take the taxes off the table. You sell it, you realize the $50,000 gain, but you pay zero taxes because you're under the threshold. Then you turn around and buy it right back at $100,000. You still own the stock, you're still good to go, but in the meantime, by deciding when to realize the taxes, you were able to take $50,000 of taxable gains off the table without paying a single penny in taxes. Now, your new cost basis is $100,000. You sell it later, let's say it keeps going up, you sell it for $120,000, you only owe tax on $20,000 of the gain, not the full $70,000. That's like legally erasing decades of taxable growth from your portfolio, and you can do it year after year as long as your income keeps you in that 0% zone. For some folks, this might be a 1 or a 2 time thing. Maybe they have particularly low income in a specific year. Maybe they own a business and it was a rough year, or maybe they just retired and they haven't turned on Social Security or pension payments yet, so their taxable income is really low for that year. Whatever the reason, following this strategy can pay huge dividends when it's done correctly. Of course, nothing in tax planning happens in a vacuum. So you got to consider all of the other areas that can impact this strategy. A couple of examples. If you're also doing Roth conversions, those add to your taxable income, which could bump you right out of the 0% bracket and just blow up this strategy. So sequencing matters. A lot of times when we have clients who would benefit from both, we'll use a couple of years for gain harvesting, and then we'll switch to Roth conversions depending upon a client's overall retirement plan. Make sure you're watching out for that stuff. Also, don't forget the standard deduction. The deduction effectively gives you extra space in that 0% bracket if you use it strategically and know your tax code. A couple other things to watch out for. If you overdo it, you might trigger the 3.8% surtax on net investment income, or you could bump yourself into higher Medicare premiums. IRMA is what we're talking about here. That's why it's critical to map this out, not just wing it. Remember, it's not about minimizing taxes in one single year. It's about minimizing it across the 20 to 30 years of your retirement. Some other common mistakes I see that you got to watch out for. Confusing gross income with taxable income. We've talked about this. That's the number one trip up. Your taxable income is likely lower than you think. So do the math before you just decide that this isn't for you. Second, don't forget that states may still tax capital gains even if the federal government doesn't. This isn't a deal breaker, but it's something to be aware of. Next up, I talked about it a second ago, but triggering IRMA by not paying attention to the Medicare cliffs. Nobody likes IRMA surcharges. Make sure that you're not making these decisions without considering the potential consequences of triggering IRMA. And finally, just don't continue to defer the gains, assuming that the strategy doesn't exist or it wouldn't work for you. And then someday you wake up and you're in your 70s and required minimum distributions kick in, and you also have all of these to-be taxed gains in your brokerage account, and you're pushed out of the 0% bracket for good. The best years to use this strategy are often early in retirement, after you stop working, but before required minimum distributions begin. We talk about that all the time as a golden window for tax planning. Make sure that you've got a tax plan to help yourself to benefit your retirement. Now, in case you couldn't tell, this sort of planning is kind of complex. It's exactly the kind of stuff that we do with clients, lining up the timing of Roth conversions, capital gains harvesting, retirement withdrawals, so that they all play nicely together in the sandbox. If you want to see how much room you might have in that 0% bracket and how to actually use it in your plan, schedule a free Clear Vision retirement plan call. The link is in the description below, and I'll see what I can do for you. The takeaway here is this: the tax code isn't always about penalties and costs. Sometimes it gives you gifts, and the 0% capital gains bracket is one of those gifts if you know how to use it. If you like this idea, you'll love the next video where I show you another strategy to cut retirement taxes that most people often overlook. I'm going to put it right over here.